So hello everyone. Today I am going to talk about in this video about the economics of banking. So the main focus of this video is to talk about that what is banking and what is the economics behind this banking and why regulation is important in banking. So let me start with a very simple structure that in our society we have households who work for a company. They consume something and from their wages, and they save something, and where they work in some company. So they work on some company, and these companies pay wages to these households, right? So once these companies pay wages to these households, what these households do actually, so they will consume goods and services of these farms, and some of the money they also save. So you see that this households, they consume, that means they give some money to this plants and these farms, and also they save some money. Similarly, you see these farms, they get some income from by selling their products which the households consume, and they pay through the prices. But also, for example, if they want to invest in plant and machinery, so they also want money. But think that you have to see this gap. Okay, these people are having money, that is enough liquidity, but they are deficient of liquidity. They want liquidity. So what happens then? Then what happens? These farms actually, what they will do, go and search for the households those who have savings. So whenever they will search, they have to go to the door. I mean, go to each doors, and each doors, and they will collect money. That will take time, and also that will delay in the investment. Similarly, the households also, they don't know the farms, so that is also source cost for the households. So here the source cost is coming from the farms, but here the source cost is coming from the households. Once households have this source cost, even they don't know about the farms, that whenever they will give credit to the farms, whether these farms are actually going to pay back their money or not. So that's credit risk is involved. So since there is no capital market, so it is very difficult, because these households are only can invest in either in local industries. Okay, but they cannot go to the all industry in the country. But then if this problem is there, then banks helps minimizing this cost. So it reduces information asymmetry, and it channelizes the savings of these households to the farms. So now you can see, so the gap has been fulfilled by the bank. So the bank is very helpful here, and it just provides, it takes a saving and it provides credit to the households, because these people also know that this household savings money is here. So instead of searching for them, so they directly go to the banks, and it is also easy. So you see that how the cost has been reduced. But the risk that bank takes is that the loans it is extending to the firms, whenever if they will not be able to pay back, then what will happen? That will have a huge cost to the households. Okay, so now I am going to take you a very simple example how this is very important. Like you see, Lakshman and Ritu are very, like, considered a village where Lakshman and Ritu are very good two friends. So they are staying in a village, and they thought that, okay, let's start a business which is similar to the banking business, and they named it as Village Bank. So whenever the name it is Village Bank, so before they starting the business, they told that, okay, how much money we both have? So they told, we have only 30 rupees with them. And since it's a banking business, they were approached to the households in the village, and they told them, you deposit money with our company, that is our bank, and we'll give you an interest rate of 4% per month, that is in the second month. And some villages trusted these two friends, and they deposited the money. So they, how much they deposited? Them deposited 70 rupees. So now you see that these two friends with the village bank are now having 100 rupees with them. That is, this is your 100 rupees with them. So what happened then? And in that village, there are another two entrepreneurs like Rabi and Rani. So they came to know that okay, the villagers have deposited the money with this village bank. So they approached. Rabi told that yes, that he needs money, rupees 20 rupees loan, and he will pay in the third month. And Rani told that she needs 30 rupees and she will pay in the second month. So Lakshmana and Ritu, they investigated the company, that companies of Ravi and Rani, and they found okay, they are fine companies, they are doing well. So based on that, they extended the credit. So now out of 100 rupees, they extended the 50 rupees as credit. Now remaining 50 rupees, they hold it in the form of cash. So this is the bank balance sheet. So in the bank balance sheet, you could see that. So initially they contributed 30 rupees, that is their own fund, and deposits amount, which is their 70 rupees. So now total is 100. And how they used this money, that is in the asset side. So you kept 50 rupees as asset, as in cash, and 50 rupees as loans given to Ravi and Rani. So now in this banking business, I'm going to tell you a very important factor or important economics behind this banking, that is the private benefits and the social cost. Like in your intermediate microeconomics courses, you must have learn about externality, private benefits, social cost, all this. Similar thing also exists in the case of banking. So let's see. Suppose, for example, Ravi told in next month that I'm going to default. I can't pay on the credit. So now, in the uses, if 20 rupees has gone, so what is the remaining money they have now? 50 rupees as cash plus 30 rupees as run. So total 80 rupees is available with them. But out of that 80 rupees, 70 rupees is house villagers' money. So what happened? 10 rupees is remained. That means the loss happened to the bank. Actually, it cut down the capital. Okay. So now capital. Suppose it took another sequence. So means Rani told that out of 30 rupees, I will not be paid 50% of that. That means Rabi already defaulted 20 rupees, and suppose Rani defaulted 15 rupees. And what will happen? So total amount is 35 rupees defaulted, and the bank is having only 65 rupees. But you know, households have 70 rupees. That means households will not be able to get 70 rupees. Only they will get 65 rupees, and 5 rupees 5 is lost. So this loss is happened to whom? To the villagers, to the society. So I call it social cost. See, suppose you imagine if these two Rani and Rabi, if these are suppose they gave very high incentive to this bank owners like your Lakshman and her friend, his friend, then what will happen? Then this Lakshman and Ditu, they will tell that okay, they may have greediness and they extend the loan to this Rabi and Rani. Then Rabi and Rani might have told them that okay, we'll give you so much very high interest rate. So that actually led to the losses, the credit losses, and that losses actually, can you see? First of all your capitals vanished. 35 rupees losses, 30 rupees your capital vanished, and the not that 5 rupees actually it is lost to the society. So your private benefit led to social cost. Therefore, there is a need for regulation. So you see your private benefits, your high return. Like if you take a very simple general banking, then your bank owners may say to the manager who executes the access of the bank that they will increase the salary if the manager will give them high return. Then the manager will involve in the risky activities that may risky activity, like they may extend the credit to risky borrowers, and at the end of the day that will be in the loss. Okay, so that loss also may come to the information asymmetry. That means the bank may not have the proper information about the company or the entrepreneurship, okay, and they are extending to the credit, and that may lead to higher default. And if it is owned by the government, then implicit insurance will also lead to moral hazard. That is, since the bank owners will think that someone is there to rescue you at the bad times, they may extend the credit to risky borrowers. And third, the fourth, the deposit insurance, which says that if certain amount of this depositors is already insured, like if you have, if, like for example, if it is 1 lakh, then a depositor will get 1 lakh or the deposit amount, whichever is less, whenever banks goes to, banks faces a very severe crisis. So you see this is a negative external. This private benefits actually brings the social cost. Okay, this is for the social cost. Social cost will affect the depositors' money. Since it is depositors' money, actually that is saving. So what is that saving? Saving is nothing but that is a planned expenditure for the household in the future. The future expenditure will go down. That means it will reduce the welfare of the households. Therefore, that will have a social cost. Second thing is that whenever there is a loss to the depositors' money and this information spreads over the locality, then all the depositors will have need to in the bank and they will withdraw their deposits. So they withdraw their deposits. What will happen? Or withdraw their deposits, then that may lead to bank runs. So when then government comes and rescues by recapitalizing or liquidating, then what will happen? That will may lead to fiscal imbalances and moral hazard. So that means there is a need of regulation. So what is regulation? So there has to be someone who has to watch this financial institution like banks very carefully. They need to look at whether they are taking risk by risking the depositors' money, or or they have enough capital. So all these things are there. Yeah. So regulations. So whenever you're thinking about the regulations, so like in India, Reserve Bank of India is a regulator. So it regulates only banks that are operating in India. Correct. Like for example, even as a US bank which is operating in India, it will regulate those banks. All those origin is from the other headquarters in the US, because the depositors, the money that is being deposited in that bank is of Indians. So that has to be regulated by the Reserve Bank of India. Similarly, in the US Federal Deposit Insurance Company, they also regulate. And if you see there is an organization who regulates these banks in a global fashion, then it will be the Bank for International Settlement, that's BIS. So BIS regulates, actually it does not regulates actually, I can say, it prescribes the regulatory measures actually. So it prescribes means it tells how much capital they need to have, what liquidity they need to have, what are the other instruments they need to invest, and all these things they explain. So let me talk about the preliminary regulations. So in the preliminary regulations, what happens? The first thing is your licensing. So whenever the regulator gives license to a company to operate as a bank, so the regulator is completely has to be satisfied or has to ensure that there should not be any hamper to the public deposits. Number one. The company that has to be adequate capital structure, that means they have enough capital, plus they should have a future earning perspectives, plus so this should be in a very good healthy position to operate. Number one. Number two is your reserve requirement. What is reserve requirement? Some money of this bank has to be with the Reserve Bank of India in the reserve account, and that will be helpful in the liquidity creation, or to control the liquidity creation. Plus, some of the money they had to invest in the government bonds, so that once they need some money, they can liquidate it and they can get money back. Plus, corporate governance. Third thing is the corporate governance, which is says that the directors, indirect director has to be near a certain proportion as prescribed by the company's law. Plus, in the organization, they have some committees like corporate secretary, auditing, risk committee, then your asset liability management committee. All this they need to. Excessive credit exposure. So the regulator also watches that there should not be excessive credit exposure to certain individual or some company or all these things. So that is very important actually. Then third is information transparency. That means time to time banks need to publish their information so that this will reduce the information asymmetry about the borrowers, the depositors, the banks, and the stakeholders. Now, those who are the preliminary regulations. Then number ex-ante regulation. Ex-ante regulation means you are taking the action before the regulation. So what will happen? One of this action would be the capital regulation. So you could see that in that case of Lakshman and D2 banking, if they would have enough capital, like for example, if they have 50 rupees of capital, even that 35 rupees of that loss now, it would not have been going to the depositors, it would have been gone from their capital. So depositors' money would have been in safe position. Since they didn't have sufficient capital, that rupees 5 went from the depositors' money. So bank need to have enough capital. So otherwise that may lead to bank runs. Okay. Second is liquidity regulation. What is liquidity regulation? You know, whenever in the banks, depositors save their money and banks issues the contract, that what happened, that the deposit contract is like that they deposit the money with the bank and any time they want they can withdraw it. So that there can be unexpected liquidity demand from the depositors. So in that case, what should happen actually? In that case, banks actually needs to have enough liquidity with them so that they can meet this unexpected liquidity demand. Otherwise, it will lead to failure, which will lead to fiscal imbalance. So that the government has to intervene and provide liquidity, and that may again can lead more charge. So then, what is the ex post regulation? What is ex post regulation is that happens whenever you already have the credit, so you got a signal that there is going to be default. So first is the provisioning. What is provisioning? For example, suppose you saw that one person had taken 1 lakh rupees loan and he vanished away or he died and no one is there in his family, then that loan has to be written off. So for that, you have to keep aside certain money. Since it is written off, so it is in the liability side. So this is provision. Second is prompt corrective action. So in the prompt corrective action, like in RBI, they have introduced it, that in that RBI that like if there is a bank with low return on assets, high non-performing assets, and lower capital to risk-weighted asset ratio, which is prescribed by BIS, then that bank comes under the purview of RBI. In that case, RBI doesn't allow the bank to extend fresh credits. So it closely watches the health of the banks. Once the bank's health improves, then they release it from the prompt corrective action watch. So these are some few very important things about the banking. So I in this video I just talked about what is the social benefit, the private benefits that the banks have, what is the social cost they bring to the depositors, and why there is a need of regulation. So this video is very simple. Actually, I told it in very simple language and it's an overview. So you know, this is the reason why the regulator exists. Because you know, banking as a business, they are risk taker because they are taking the deposit. That means they will extend the credit, and extending credit is always a risky business. But at the same time, they should not take excessive risk. So their actions of taking excessive risk has to be mitigated. And it has to be mitigated, not only be mitigated, it has to be observed, it has to be verified by someone regulated. So this is the need of regulation. And you know, so although Reserve Bank of India having a monetary policy and banking regulation, so this video I'm just explaining that why this regulation is important, and this relates to the existence of Reserve Bank of India. So thank you so much. Actually, I shared this video in a simple language as much as possible for me. Okay, so thank you so much for watching the video, and thank you.